Hey friends, I am back with a quick video. If you're new to the channel, my name is Oliver. I am a digital nomad, currently traveling the world, and I'm paying for it with trading, mostly through options income trading, which is a very hands-off style that is you don't have to be glued to the screen, it's not very time zone dependent, so I think it's perfect for this kind of life. Anyway, and on this channel, I'm sharing a lot of some of the things that I'm doing with my trading, and maybe also some of the digital nomad stuff in future videos. So subscribe and hit the bell if you want to stick around for those. But today I'm going to talk about a particular options income spread strategy called the calendar trade. Now, like in the past, I thought it might help if I did a kind of an analogy to lead up to the discussion of calendar spreads, because all of these options trading concepts tend to be super abstract. So if I can ground it in something a bit more real world, maybe it makes it easier to understand. So bear with me, and I hope it does help. Many of you know I used to live in Hawaii. This is the view from my old balcony. It was amazing to wake up to this every day. I didn't always get a rainbow, but then once in a while I got 2 rainbows, so that kind of made up for it. But as Hawaii was beautiful, it was also a very expensive place to live. So what I would often do is I would drive across the island to Costco, which is kind of a big discount warehouse market. Very popular in the US. So there was one on my island, and I would go there and I could buy things. Sometimes they would be in bulk, but you would get a really good price. So that's Costco. Now, unfortunately, the drive was 90 minutes and you had to drive across a mountain both ways. So it was quite an undertaking, and anytime that I was going to Costco on the weekend, I would let my friends and coworkers know, hey, I'm going to Costco this weekend, so if there's anything you want me to pick up, let me know and I'll get it for you while I'm enduring this. So we're going to use that as an example to demonstrate the concept that I want to talk about for calendars. So we're going to say I'm going to Costco, and I ask around, and my friend John says, yeah, could you get me a new thing of laundry detergent? It costs about 25 bucks. Here, I'll cash you up. I drive over to Costco, and when I get there, unfortunately, they're only selling the laundry detergent in 2 packs. So I have the $25 that John gave me, but the 2 packs are selling for 40. I decide, being a good friend, okay, I'm just going to go ahead and buy it, and John will get his thing of laundry detergent. I'm only out net $15. So all I have to do is down the road at some point find somebody who will buy the other container of detergent for at least $15, and then I'll have broken even. And if I can sell it for $25, I'll actually make $10 for my trouble. And why not? I drove all the way across the island, had gas expenses and so forth. So I go ahead and I buy the 2-pack, which is a better rate on a per carton basis than the $25. And I hope to make a little bit of money in the difference. That's the basic concept that's going on here. It's like a bulk arbitrage. So keeping that in mind, with the sort of the 2-for-1 pricing, keeping that in mind, we'll take a look at the options chain, where obviously things are a little bit more abstract. Just remember this example, and hopefully it'll be a little easier to follow. So if you're completely new to options, I would recommend watching some of my other videos, like the beginner's trading strategy and stuff, to talk about what they are. But we are looking at an option chain here for the SPY, which is an ETF that tracks the S&P stocks. And calendars, you want to do with them in things that are expensive, like this is 400 bucks. And also things that are very liquid. SPY has very liquid options. I would recommend doing this in the SPX or the RUT, which are index options, as soon as you're comfortable. But SPY can be a good place to start. What we're going to do is, instead of the 2-pack, we're going to be looking at 2 months. So what we want to do is buy an SPY contract that is a 2-month contract, and then we're going to sell it off in 1-month chunks. Like the Costco example, we're selling the first one right away. That's the one we're giving to John. We already got the money for it. So here's, normally I look for around 30 and 60, and I prefer the monthlies. These orange ones are weeklies. They're fine in SPY. They can be a little less liquid in other underlyings, but we'll just use these white ones. And this is close to 30 and 60. So this is our 1-month option, and this is our 2-month option. And for this, we're going to go as close to the current price as we can. So 445. That's this 445. I'm going to use puts. It doesn't really matter much whether you use puts or calls. We'll come back to that, I guess. I'm buying the 2-pack. I'm at Costco, right? So I'm buying the 2-pack, and then I'm selling one right away to my friend John. It looks like that. And you can do it as a single order. So you can see here, that's the one I'm selling. and then that's the 2 months that I'm buying. And so I am out the difference between the two. I'm out the $2.07. Options have that 100 times multiplier, so this is really a $200 commitment. This number, this is the most you could lose in this trade no matter what. This is your maximum loss. It's not necessarily where you would pull out of the trade at a loss. You'd probably pull out for a much lower loss than 207. So the idea is we put this trade on, and now we have 1 month already sold, and then we wait. So pretend this is a 30 and 60 just to keep things, simple. We've already sold 30, right? And we wait the 30 days for that to decay. Market doesn't move. It expires worthless. We got to keep that premium. This November option that's at 60 days, 30 days from now, that would then be a 30-day option, and we would turn around and sell that for whatever we could get for it. Now, how much would that be? Not as much as it was, today, but a good guess would be about what it was now for the October. 30 days from now, that November will probably be selling for $655 if we had to guess. So we've sold two 30-day options for $655, and we originally paid $863-ish for the November. That's pretty much the concept. I actually don't recommend staying in one of these calendar trades until that front month, all the way till the front month gets to expiration. These aren't laundry detergent. You can actually jump in and out of this trade. So you can get out of this trade as soon as you have a reasonably healthy profit. For SPY, I might target something like a 25% return on this debit here. So you'd put it on for 207, maybe you're trying to get out at like 250. But if you're doing it in SPX or RUT, this number will be bigger and you'll have less contracts to throw around. You could probably do more like a 10% target. Let's go ahead and throw this in the analyze. So here it is in the analyze. This is I've shown this on the other strategies before, but this purplish line is the model's prediction of your P&L on a move up or down in the market when no time has passed. We make money when time passes, so that's not showing up there. So if we immediately had a move up or down in the market, in either direction, we're losing money, which isn't surprising. This is not intended as a directional trade. So this is delta neutral, just like the iron condors and the broken wing butterflies. Delta's near zero. We just want the market to hang out around where it is. Now, over time, that purplish line is going to creep up and turn into this light blue line. This light blue line is the model's price prediction at expiration. But we have two expiration dates. It uses the closer expiration of the option we sold to decide what to show for the light blue line. This is in Thinkorswim, right? So I can show you the time passing. So if we look at 1 week intervals, now the model is showing us 1 week out, 2 weeks out, 3 weeks out. Down here you can see it showing the P&L when I hover over something. So yeah, somewhere in there, 3 weeks from now you'd pull the trade off. On a move up or down, if theta goes negative, I would keep an eye on your theta. And if that theta goes negative, that means the trade isn't bringing in money anymore over time. It's out here somewhere. It's becoming a problem. I would just cut the trade. I would also cut the trade if you were within a week of this front, right? So October 13th, I would just get out of the trade no matter what at that point and just take whatever profit you have. So that's a simple overview of how the calendars work. There's kind of a lot more behind them, but you don't have to be complicated with these. Now, when I put these on, I would like to see that the price on this back option is much less than double the front month option, right? For obvious reasons. This is a delta neutral trade, as I'm showing it here. But I just did want to mention, some traders do like to use these when they need to throw a little bit of delta on for some reason. So meaning maybe they're balancing their portfolio's delta or they're bearish on something, but they still want it to be like an option income trade. So for example, if instead of going at the money, if we decided to do, let's say the 435s, we could throw this trade on. It costs almost the same, right? $2, but we do have some negative delta now. And a down move is helpful to the position. So if you wanted it to be, and it still has positive theta, so kind of like put credit spreads, this has a bit of both. You can express a directional view and you can collect theta at the same time. You can also do this on the upside. If you're doing calendars above the current market price, any calendar you do, it doesn't really matter if you do calls or puts. They basically end up working out exactly the same. But calls are more liquid above the money. So, and puts are more liquid below the money. So when you're trading something and you're picking a strike like 450 when the market's at 445, if you don't have a reason otherwise, I would recommend just use calls. It'll feel a little bit easier. I like to use 30 and 60 days to expiration, but there are people who do, especially if you're using a really big underlying like the RUT, the RUT, you can do things like 7 days and 14 days. That's not my preference, but there are certainly people who do. Also, I mentioned I would get out if theta goes negative. You can see for a given position, you can group your trades or whatever. Your platform will show you some sort of composite theta for things. So you can see when your theta for something goes negative. Just keep an eye on it, like once a day. So yeah, that's calendar spreads. I don't tend to trade these standalone, but you can. But I wanted to show them because I'm doing some complex spread trading. One of the trades I have on right now, it's a put broken wing butterfly, which is the trade I showed last time, but it's been combined with a call calendar. So I'll be talking about how I do that kind of stuff in future videos. If you want to see those, or just in general, see how things go for me, hit subscribe, hit the little bell icon. A thumbs up goes a long way. If you have questions about anything trading related or how things are going for me or anything like that, or topics you want to see me cover, just toss them in the comments down below. I'll see when I can get to them. And thank you for watching, and I'll see you guys next time. Ciao.